Hey, everybody out there. Thank you so much for tuning in to Market Takes. This is my live stream. I am Dion Rabouin, a markets reporter for the Wall Street Journal. And again, you were watching Market Takes. We are live streaming right here on YouTube. Thanks for joining us and being with us. We are going to talk about everything going on, all things markets, economy, data, and just everything that's going on. I'm going to talk through what's coming out this week and what I think investors, money managers, and just folks who are interested and concerned about what's happening in the economic environment, what's going on in the world, should be looking out for this week. So we're going to go through all that. I'm going to talk through the big reports coming out this week. We're going to talk through what's going on in markets and just really break down everything that I think you ought to be looking out for in the markets for the rest of this week. It's Monday, so we are getting started right now on a rough patch. We're going to check in on the markets, look at stocks, bonds, oil, gold, kind of how everything's moving in the markets. And right now, it's a rough day, a lot of red out there on the markets. As I look at it, WSJ.com, I'm seeing the S&P 500 down a little more than 1%. The NASDAQ down about 0.25%, and the Dow down about 0.8%, kind of straddling in between those. As we look out into the oil markets, we're seeing oil down about 5% on WTI and Brent crude down about 5.3%. Those numbers, though, coming back a little bit from the lows of where we were earlier in the day. The 10-year yield at about 2.79%. That's down from where we finished last week at 2.91%. So bond yields coming down, which means prices going up, which is good if you're a bond holder. Means that some of those worries maybe are coming back in, and that folks are getting a little more worried and buying bonds, those safe assets. We're also seeing a big increase and a spike in the dollar as folks move out of those other currencies, currencies that might be a bit more affected by geopolitics, the war in Ukraine, these worries about China's COVID-19 slowdown, and moving into the kind of global safe haven, the US dollar. We're seeing that rising. And again, this is a continuation of what we saw last week. We saw bond yields spiking higher, prices going down, stock prices going down, oil prices coming down, and just kind of a broad sell-off of everything. Crypto, you name it, the price is down today. And we've seen that kind of consistently coming from last week. If we remember last week, the S&P 500 was down more than 2.7%, almost 3% for the S&P. NASDAQ down almost 4% last week, both down for 3 straight weeks. The Dow was down almost 2%, but it was actually headed for a weekly increase until Friday when it lost 2.82%, its worst day since June 11th, 2020. So again, we're seeing those consistent rise. The 2-year yield jumped 27 basis points last week. The 10-year yield rose 10, almost at 3%. That's a very important level because when yields hit 3%, that's really the number that a lot of economists and asset managers pointed to and said, okay, that's a level where folks start moving out of stocks and really start moving into bonds. Bonds become much more attractive because you're getting essentially a risk-free asset. You're getting paid 3% to hold that, and that's an important number as well because, you know, if you're a business trying to borrow money, that raises your borrowing costs to a significantly higher level. So watch out for that 3% number on the 10-year yield. Right now, bond yield's coming down, so we're not really headed there, but we'll see. We could get there definitely by the end of the week. Second quarter so far has not been kind to stocks or bonds, and we've seen today Chinese stocks really selling off, European stocks selling off. We're seeing a lot of red. And that's all happening despite a pretty solid earnings season. Most companies have beaten their projected earnings. As you know, we are in week 2 of earnings season in terms of the big companies. And we've seen pretty solid numbers right now. 79% of companies are reporting above average earnings or above expected earnings. So even though we are getting those solid numbers from companies, still seeing this continued sell-off, and that really seems to point to worries about this global growth environment, rising inflation, worries about declining growth and lower than expected growth numbers. We had a note out from Allianz Chief Economic Advisor, Mohammed Al-Arian, this morning saying it's worries about stagflation that are really spooking investors. Stagflation, if you're not familiar, just means high inflation that continues to hold higher and growth that continues to hold lower. And that discrepancy where, you're not seeing a lot of growth, but you're seeing prices continue to rise higher and higher and higher. So definitely something to keep your eye on out there in the market. We are going to get what I think will be a more than expected or a more than typical response from the market from first quarter GDP on Thursday. I think that's the big report to watch, and I'm going to tell you why. We're going to get into that a little later in the live stream. We're also going to talk about these inflation reports. We are getting the Fed's favorite gauge of U.S. inflation this week on Friday. We also get a report on the employment cost index. So those are going to tell us a lot about what's going on in the inflationary environment. I'm going to tell you what to look through there. We also get durable goods and wholesale inventories. Those are kind of, for the nerds out there, but I think they could have some real market moving implications this week as well as confidence data, consumer confidence data from both the Conference Board and the University of Michigan. Those are the two big reports that come out about consumer confidence and sentiment. We get both of those this week. Also, big reports on housing. We get the Federal Housing Finance Agency's price index, as well as the Case-Shiller price index. Both of those for March coming out this week on Tuesday. We also get new home sales report, and we get the pending home sales report on Wednesday. So again, a lot of information we're going to get about the housing market, which is going to tell us a lot about the overall economy, and if consumers are really just starting to walk away because of some of these higher prices. All this, I think, could move the market because it's going to tell us what consumers are thinking and whether this high inflation, high rates, and high prices are getting folks to say, hey, you know what? I'm just going to stay home. So let's talk about it. Let's get into it on GDP and why I think that's going to be the big report on Thursday this week. It's typically not well followed. It's not a big market mover when it comes out because it's looking back at 3 months of data, right? So we find out in April what happened in the first quarter, January, February, and March. That's usually not a big market mover because we're in April, right? When we're towards the end of April. What happened January through March, not necessarily all that important. I think this is going to be different because we've seen IMF, the World Bank, OECD, all these big time, big name international organizations say, hey, we think growth is going to slow down, moderate, and really decline in terms of the pace of growth. So if that happens, GDP is going to tell us, are we on pace now for those lowered expectations, or are things actually worse than expected? Conversely, are things better than expected? Could we continue to grow at that higher pace that we did in 2021? That is not the expectation really of anybody. So more than likely, we will see a miss to the downside. And if that happens, that could really start to worry the market. This GDP number is going to tell us a lot about what happened in the first quarter and why. One of the things that I think is the most interesting thing to look at is going to be this inventories number. Now, inventories, for those of you who don't know, is just essentially companies buying things to store them, put them away, stockpile for a rainy day. When you're buying a lot of things for inventories, you're not buying because your sales are running off and you have to replace merchandise on the shelves. You're buying so that you can put things away in storage and hold them. About 70% of Q4's GDP was accounted for by inventory growth. Essentially, 70% or more than 2/3 of that growth came from inventories and companies buying stuff to put it away. That was revised higher to 78%. So almost 80% of Q4 GDP growth was from these inventories and folks just buying things to stockpile and put them away. What does that number look like in the first quarter? That's, I think, going to tell us, okay, were these things that companies bought because they expected sales to be higher, because they expected to not be able to keep up with the pace that people were buying things at? Did they buy them? Did they actually sell them? Did they move off the racks? Or are companies still just stockpiling, trying to catch up because these COVID shutdowns, these supply chain bottlenecks have just kept coming and coming and coming? Were we able to actually see concrete sales numbers? Or are we just seeing more companies stockpile things away because they're scared of running out? That's going to be a big theme in the first quarter GDP that I don't know if it's gotten kind of the attention that it deserves from a lot of media folks out there. We also saw within that Q4 GDP report, personal consumption for goods and services both revised lower. So that's not a great sign for that sales, those sales that we need for GDP, because The US economy is all about services. It's all about things moving and shaking. 70 to 80% of the entire US GDP is this services number, and we have seen a lot more buying of goods and a lot less buying of services. We need to see that pattern change, and for now that, we're out of mask mandates in most of the country, we're out of, sales or stores saying you can only have so many people in your store for such a, where restrictions are being lifted, COVID restrictions, mask mandates, all those things are being lifted. Are people going back out and are they buying? Are they going to the store? Are they going to the movies? They're taking their family out, things like that. So that's, I think, a big thing to look for in the first quarter GDP report released on Thursday. Now, the other big thing, I think we're going to get this inflation data. We're going to get the PCE report, personal consumption expenditures. That's what the Federal Reserve looks to when they're deciding, okay, are we going to raise rates, lower them, keep them the same? They look at PCE, and that report's out on Friday. We are going to be doing a special live stream on Friday at 11 a.m., unpacking and looking into everything within PCE, what the report said, what the numbers were, what they mean, and how the market responded to that. So check in with us Friday at 11 a.m. We're going to be discussing all of that, as well as the employment cost index that comes out on Friday. There's a big theme right now within markets, which is that economists are saying, hey, wages are rising too fast, but wages aren't even keeping up with overall inflation. So we'll find out a lot of things on Friday, and I hope you'll be with me on Friday at 11 a.m. as we unpack that. We also get this week durable goods, wholesale inventories, and a number of these indexes from the Federal Reserve in terms of manufacturing and the overall economic indexes from the Federal Reserve. We get the Chicago Fed National Activity Index, the Dallas Fed Index on Monday, Richmond Fed Index on Tuesday, the Kansas City Manufacturing Fed Index on Thursday, and Chicago Purchasing Managers Index as well on Thursday. So we're going to get a view of the economy from multiple different places around the country, and I think that's going to tell us a lot about where we are in addition to that first quarter GDP report. So again, this upcoming week, we're going to get those numbers on durable goods and wholesale inventories, as well as that's going to come from March. But we'll also get this Q1 GDP number that I think is going to be a big market mover, provided it doesn't just come in right at the numbers and folks really start to unpack that. So thank you all again for tuning in and being with us on the live stream. We're talking through what investors and really anyone who's concerned and interested in the economy should be looking out for this week. We get the Q1 GDP report on Thursday. We get a number of different reports on durable goods, wholesale inventories. Those are going to be coming out on Tuesday and Wednesday. And we get those reports from the Federal Reserve throughout the week. I think those are going to be not as impactful for the market, but definitely something to keep your eye on. Also this week, we get consumer sentiment indexes from both the Conference Board and the University of Michigan. Those are the two most widely followed indexes of consumer sentiment and confidence. They're going to tell us how folks are feeling about these things, how excited or how down really are people on the economy. The University of Michigan's index has been around a decade low for the past 3 or 4 months. Does that trend continue? The preliminary report that we got from the University of Michigan at the beginning of the month showed us that we're seeing an increase in sentiment for the first time since December. Does that actually get, confirmed in terms of this end of the month report that goes back and checks in with more folks, crosses the T's and dots the I's and looks and says, okay, was this on point? And we'll find out on Friday when we get the University of Michigan's report. On Tuesday, we get the Conference Board's index of consumer confidence, and that's going to tell us a lot. That number has been going down. We still haven't recovered from the pandemic drop-off in the Conference Board's survey, but we are seeing that number a lot higher than the University of Michigan's number. Conference Board's number has been picking up steadily since 2009, but then obviously the pandemic hit and it sunk, and we really have not recovered to those gains that we saw back in 2019 towards the beginning of 2020. So the index picked up last month. Does it continue? Economists are expecting for that number to decline again. Consumer sentiment is what motivates buying. Buying motivates, more sales. More sales motivates higher wages and more hiring. All those things, we need to get back to that virtuous circle rather than the vicious cycle of the economy. And consumer sentiment, I think, is going to tell us a lot about that. So Tuesday and Friday, we get the Conference Board's report and the University of Michigan's report. I think those are going to be very telling. We also get some data on the housing market, which is something that I've been watching very closely over the past few weeks. We're going to get the FHFA, the Federal Housing Finance Agency's price index, and the Case-Shiller price index on Tuesday, both very followed and both really dive deep into what's happening in the housing markets. Have prices that have risen this year at about 10 to 15%, do they continue on that ascent? Most economists only expected prices to rise about 3 to 6% this year. So if prices are still rising at 10 to 15% through the year, how does that work? If I think a lot of economists are going to have to rewrite their expectations for housing prices, and are more people going to get priced out? As rates have risen, now up over 5% average on a 30-year fixed rate mortgage, if prices keep rising at 10 to 15%, who's going to be able to afford these houses? Not a lot of people. So again, that's going to be big. We get FHFA and Case-Shiller on Tuesday. We also get new home sales report and the pending home sales report on Tuesday and Wednesday. That's going to tell us a lot about where things are going and where they've been, and likely where things are headed with these new higher rates. Again, rates spiked up in March, so we'll finally see some data on how consumers reacted within the housing market. We are wrapping this thing up. Thank you so much for being with us on the live stream. Again, this week we got data on Q1 GDP. I think that's going to be the big market moving report that's going to tell us a lot about the economy this week. We also get durable goods, wholesale inventories, and those Federal Reserve reports on the economy, as well as consumer data and housing data from a number of different companies, Case-Shiller and FHFA. Looking at the markets, the NASDAQ has gone positive. We are now up 0.25% on the NASDAQ, the S&P 500 down about 0.5%, and the Dow down about 0.25%. So moving back into the green for stocks. The 10-year yield now at about 2.8%. So things starting to improve. We saw really the sell-off going through the day, and now it seems like we're picking back up. So where we end the day, I think, will be very telling of the overall sentiment of the market and of the momentum and where we're headed. And I think we're going to learn a lot this week about how resilient investors think the economy is and how resilient they are. Are they willing to step back into the market and buy, or are they still hanging on the sidelines and selling, doing things like that? So we will learn a lot on Friday. I hope you'll be with us as we do a deep dive into PCE. We'll also look back at the week that was, talk about what happened on markets, and how we expect this inflation data that we get on Friday to influence the Federal Reserve going forward, and how we expect that to influence investors going forward in the market. I'm Dion Rabouin. Thank you all so much for being with us on this live stream. We're going to do it again 11 a.m. Friday. We're going to unpack a special version. We're going to unpack PCE and inflation. So I hope you'll join us for that. Thank you so much for being with us on this live stream, and I hope to see you Friday at 11 a.m.